Did you know that millions of Australians could be hit with higher taxes in 2026, even if they earn the same amount as last year? That's right. Despite promises of relief, new forecasts suggest a silent tax storm is brewing, and it's got everyday workers right in the firing line. From vanishing tax cuts to creeping inflation, unexpected policy shifts are quietly setting the stage for what could be the biggest personal tax shakeup in decades. And here's the kicker. Most people won't see it coming until it's too late. One small change in your income, one tweak to the system, and suddenly you're paying hundreds or even thousands more. Sounds unfair? Maybe, but it's happening. So what exactly is going on, and how can you protect yourself before it hits? Stay with me, because the next few minutes could save you a fortune in 2026 and beyond.
Number 1. Stage 3 tax cuts reforms. Gone wrong? Back in 2019, the Australian government promised a major shakeup to the income tax system through what's known as the Stage 3 tax cuts. These cuts were designed to simplify the tax brackets and reduce the tax burden for millions of Australians, especially middle and high-income earners. On paper, it sounded like a win. Fewer tax brackets, lower rates, more take-home pay. But fast forward to 2026, and things are starting to look very different. With growing pressure to address rising government debt, income inequality, and cost of living crises, Stage 3 is now under intense scrutiny. There's talk of modifying, delaying, or even scrapping parts of the reform altogether. If that happens, many Australians who were expecting a tax break could instead find themselves paying more, in some cases significantly more. Imagine planning your finances around a lower tax rate only to get hit with a surprise hike just as bills and groceries cost more than ever. Economists argue that the current structure of Stage 3 disproportionately benefits the wealthier portion of the population, which makes it a political hot potato. But here's the catch. If the government rewinds these cuts, it could pull millions of workers back into higher tax brackets, especially those earning between $90,000 and $120,000, a range that includes teachers, nurses, and small business owners. So is the tax relief really coming? Or is it a mirage in the desert of rising living costs? This is just the first reason why 2026 could deliver the tax shock like we've never seen before. And it gets even more complicated from here. If you're finding this info useful so far, hit the like button and let us know in the comments. Do you think Stage 3 should go ahead as planned?
Number 2. Bracket creep is back. It's one of the most frustrating parts of the tax system, and it's happening again. Bracket creep, also known as fiscal drag, is when your income increases just enough to push you into a higher tax bracket, but not enough to actually improve your standard of living. In simple terms, you earn more on paper, but after tax, you're not really better off. And with wages slowly rising due to inflation, millions of Australians are walking straight into this trap, often without even realizing it. Here's how it works. Let's say you receive a small annual pay rise, just enough to keep up with inflation. That extra income can tip you into the next tax bracket, where a higher percentage of your earnings is taxed. Suddenly, that modest raise doesn't feel so rewarding anymore. It's not that you're making too much money, it's that the tax brackets haven't shifted to match the real cost of living. The problem is that Australia's tax brackets aren't automatically indexed to inflation. So, as prices rise and wages follow, more and more people fall into higher brackets, paying more tax without actually earning more in real terms. This stealthy mechanism boosts government revenue, but it quietly chips away at your take-home pay. For everyday Australians, from office workers to tradespeople, this means paying thousands more over time simply for trying to keep up with rent, fuel, and groceries. The real kicker? Many don't even notice it's happening until tax time. It's not a new tax, but it feels like one. And in 2026, with inflation still lingering and wage increases likely continuing, bracket creep is poised to take a bigger bite than ever out of household budgets. Number 3. Inflation-driven income gains. At first glance, getting a pay rise sounds like good news, a reward for hard work, or at the very least, a necessary adjustment to keep pace with the rising cost of living. But in 2026, many Australians may discover that those inflation-driven income boosts come with an unexpected sting in the tail: higher taxes. Here's the twist. As wages increase to keep up with inflation, people move into higher income brackets, triggering larger tax bills even if their real purchasing power hasn't improved. So while your paycheck might be slightly bigger, you could find that more of it is being swallowed up by the tax system. In essence, you're paying more tax without actually feeling any richer. This issue becomes even more troubling when combined with bracket creep. When tax thresholds don't move alongside inflation, even small income increases can result in disproportionate tax jumps. It's like climbing an escalator that's going down. No matter how hard you try to move forward, you end up staying in the same place, or worse, falling behind. Inflation also affects things like allowances, benefits, and deductions. Many of these aren't indexed either, meaning their value diminishes over time. As a result, what used to be a helpful offset or rebate may no longer make much of a difference to your final tax bill in 2026. What makes this even more complex is the psychological effect. People naturally expect to feel better off when they earn more, but when the cost of essentials like rent, fuel, and groceries rises faster than take-home pay and tax takes a bigger bite, it leads to frustration, financial pressure, and a sense that the system just isn't working. In 2026, this disconnect between nominal income gains and real financial security could leave millions of Australians caught in a taxing trap they never saw coming.
Number 4. Superannuation tax changes. Superannuation has long been viewed as the safest way for Australians to build wealth for retirement, a tax-effective savings plan that rewards long-term thinking. But in 2026, that perception may start to shift as new proposed superannuation tax changes begin to take effect, and the impact could be far broader than many realize. The government has already announced plans to increase the tax rate on super balances above $3 million from 15% to 30% on earnings. At first glance, this might seem like a measure that only affects the ultra-wealthy, but here's the catch. With rising property values, growing investment portfolios, and decades of compulsory super contributions, many average Australians, especially those in their 40s and 50s, are slowly creeping toward that threshold. What once seemed like an unreachable figure could soon be within striking distance, especially for dual-income households and business owners. And the implications don't stop at the tax hike. The change has also sparked uncertainty and anxiety around superannuation policy more broadly. If the government can shift the rules now, what's to stop future increases in tax rates or further lowering of the threshold? This unpredictability could discourage people, particularly younger Australians, from fully engaging with super, potentially weakening the system over time. There's also concern that these changes create a descendancy to save. If people believe their retirement savings will be heavily taxed after a certain point, they may redirect their funds elsewhere, possibly into riskier or less transparent investment vehicles. Ultimately, the upcoming super changes reflect a deeper shift in how wealth is being taxed in Australia. And for many, 2026 could mark the beginning of a more aggressive approach to retirement taxation, where those who plan ahead and save diligently may no longer be rewarded, but instead penalized for their success.
Number 5. End of temporary tax reliefs. During the height of the COVID-19 pandemic and the economic downturn that followed, the Australian government introduced a range of temporary tax relief measures to ease financial pressure on households. One of the most impactful was the Low and Middle Income Tax Offset, known as the LMITO, which offered tax relief of up to $1,500 for eligible earners. For millions of Australians, this offset meant a larger refund or a smaller tax bill, and for some, it became something that quietly counted on each year. But in 2026, these temporary reliefs will be completely phased out, and that's where the shock sets in. Without the LMITO, Many taxpayers will find their refunds shrinking dramatically, or worse, they'll owe money they weren't expecting. This isn't about earning more or claiming less. It's simply because a benefit that used to cushion their tax burden is no longer there. The end of these temporary offsets creates what experts call a tax cliff. There's no gradual transition or easing out. The benefit just disappears. So someone who received a sizable refund in 2025 might be hit with a much smaller one in 2026, even if their income and expenses haven't changed at all. This will disproportionately impact low and middle-income earners, the very groups that are also battling rising living costs, rental hikes, and stagnant wage growth. And because the offset was paid through the annual tax return process, many people won't even realize what's changed until tax time. It's a classic case of quiet policy reversal. No new tax introduced, just the removal of one that helped millions stay afloat. And while it may not grab headlines, the financial impact will be deeply felt across households, especially those already walking a financial tightrope in an uncertain economy.
Number 6. Crackdown on work-from-home deductions. The rise of remote work during the pandemic brought a wave of flexibility, and with it, the opportunity for millions of Australians to claim generous tax deductions for their home office expenses. From internet bills to electricity usage, mobile phone charges to office furniture, the ATO had provisions in place to support this massive shift in how we work. But in 2026, things are changing, and not in favor of the taxpayer. The Australian Taxation Office has announced a tighter, more simplified, fixed-rate method for claiming work-from-home expenses. While it may sound easier on the surface, this revised method reduces the scope of what you can claim and removes certain key items, such as depreciation on office equipment or dedicated workspaces, unless specific conditions are met. Under the new rules, taxpayers can claim 67 cents per hour work from home, covering energy, internet, and mobile phone use. But to claim anything more, you'll need detailed daily records. This new documentation requirement has caught many off guard. In previous years, you could estimate or average your hours over a period. Now, if you haven't kept precise logs, your claims could be denied, even if the expenses were legitimate. Freelancers, contractors, and employees who regularly work from home will likely feel the biggest financial impact. Those used to receiving a few hundred or even a few $1,000s in deductions may see that number shrink considerably in 2026. What's more, the ATO has flagged increased audit activity around these deductions, signaling a crackdown on incorrect or inflated claims. That means even small mistakes could raise red flags, leading to delays, audits, or penalties. The bottom line? The golden age of relaxed home office deductions is over, and for many remote workers, this change means higher tax bills and more red tape, even as working from home becomes the new normal.
Number 7. Rising property taxes and land levies. Owning property in Australia has always come with its share of costs: mortgage repayments, maintenance, insurance. But in 2026, many Australians will face another hit: rising property taxes and land levies. State governments, grappling with budget shortfalls and declining revenue streams, are quietly increasing these taxes to balance the books. And unlike income tax, these charges are often harder to predict and harder to avoid. In states like New South Wales and Victoria, land tax thresholds are being adjusted, not necessarily in your favor. More properties are falling into the taxable category, and existing rates are inching higher. If you own an investment property, even a modest one, chances are your annual land tax bill will be noticeably larger. And for those who own multiple properties or commercial assets, the increases can be staggering. But it's not just traditional investors who are affected. With skyrocketing house prices over the past decade, many everyday Australians, including those who inherited a family home or invested in a small apartment for retirement, are now being treated as wealthy landlords in the eyes of the tax system. In some cases, people are being taxed on properties they don't even earn income from simply because the land value has risen. On top of that, local councils are also under pressure. Expect to see higher council rates, new service charges, and special levies being introduced, especially in growth areas or regions hit by infrastructure upgrades. These extra costs might seem small individually, but together they can put serious pressure on household budgets. For property owners, this is a wake-up call. The idea that property is a safe, low-maintenance investment is quickly being challenged. In 2026, taxes tied to land and property could become a significant financial burden, chipping away at rental returns, equity, and long-term plans.
Number 8. Wealth and inheritance tax rumors. One of the most controversial discussions gaining traction in Australia's political and economic circles is the possible introduction of a wealth or inheritance tax. While Australia currently has no formal inheritance tax, that could change as early as 2026, as government advisors and economists push for new ways to tax wealth rather than just income. And although nothing is confirmed yet, the signs are becoming harder to ignore. Recent reports from think tanks and international organizations like the OECD suggest that Australia is falling behind in taxing generational wealth. With a growing gap between rich and poor and an aging population set to transfer trillions in assets over the next 2 decades, the pressure to act is mounting. The logic is simple. Why should someone earning a wage pay more tax than someone inheriting millions tax-free? There have already been whispers of models where estates above a certain value, say $2 or $3 million, could be taxed before assets are passed on to beneficiaries. This wouldn't just hit the ultra-rich. With property values soaring, particularly in major cities, many Australians could find their family homes or modest investment portfolios triggering a tax they never planned for. Even without a formal inheritance tax, changes to capital gains tax rules or superannuation death benefits could achieve the same outcome, taxing the transfer of wealth more heavily. Financial planners are already warning clients to prepare for the possibility, with strategies focused on gifting assets early or restructuring ownership. While the idea of a wealth or inheritance tax remains politically sensitive, history shows that when governments need revenue, few areas are off limits. In 2026, Australians may find that what they thought was a family legacy could instead become a surprising tax liability, sparking tough decisions and reshaping how people think about generational wealth.
Number 9. Decline in GST share to states. Behind the scenes of Australia's tax system lies a complex revenue-sharing arrangement between the federal government and the states, and in 2026, it's starting to show cracks. The Goods and Services Tax, GST, which was designed to be a stable source of income for state governments, is becoming less reliable as consumer habits shift and economic pressures mount. As a result, states are receiving a smaller share of GST revenue, and they're now looking for new ways to fill the gap, often by raising their own taxes. So, what does this mean for the average Australian? Quite simply, expect to pay more in state-based taxes and charges, even if your income or spending habits haven't changed. States may increase stamp duties, payroll taxes, land taxes, vehicle registration fees, and a range of council levies just to stay afloat. These aren't federal income taxes, but they hit just as hard, especially because they're often tied to essential services like housing, transport, and employment. Part of the problem is structural. As more people spend online or shift their spending towards untaxed or lower-taxed digital services, GST collection naturally declines. Combine that with population growth, infrastructure demands, and mounting debts from pandemic-era spending, and it's no surprise that state governments are tightening the screws. In some regions, we're already seeing new taxes being introduced on things like short-term rentals, vacant properties, and luxury goods. Subtle but impactful measures designed to plug holes in the budget. These taxes can feel sneaky because they're rarely announced with fanfare. Instead, they quietly appear on bills, registration notices, or property assessments. The bottom line is that as the GST pie shrinks, state governments are forced to carve out their own slices elsewhere, And that means more hidden costs and unexpected tax hits for ordinary Australians in the years ahead.
Number 10. Shifting global tax pressures. While most Australians focus on local tax rates and national budgets, there's a much larger storm brewing on the global stage, and it's headed straight for 2026. International tax agreements, driven by organizations like the OECD.
Number 10. Shifting global tax pressures. While most Australians focus on local tax rates and national budgets, there's a much larger storm brewing on the global stage, and it's headed straight for 2026. International tax agreements, driven by organizations like the OECD and G20, are pushing for major changes to how countries tax multinational corporations and digital businesses. These changes may sound far removed from everyday life, but they're about to have a very real impact on Australian households. One of the key developments is the Global Minimum Corporate Tax, a plan to ensure that large multinationals pay at least 15% tax regardless of where they operate. While this targets giant companies like Google, Apple, and Amazon, the ripple effect could mean higher costs passed down to consumers. As companies adjust to tighter tax rules, they may raise prices, cut local investments, or shift expenses, moves that inevitably affect jobs, prices, and local competition. Australia is also exploring a digital services tax aimed at tech platforms that generate significant revenue from Australian users without paying much tax here. While that's meant to level the playing field, it could lead to higher prices for streaming, subscriptions, digital ads, and online services, costs that many Australians now consider essential. On top of that, local businesses involved in international trade, e-commerce, or cloud-based services may face more complex compliance rules and reporting requirements. That means higher administrative costs, which often trickle down into the products and services you pay for. These global tax shifts are about fairness and accountability, but in practice, they introduce a layer of uncertainty and cost. As Australia aligns with international tax standards, the result could be a stealthy rise in consumer-level taxation, where the burden doesn't show up on your payslip, but in the prices you pay and the services you rely on. As we look ahead to 2026, one thing is becoming crystal clear. Australia's tax landscape is changing, and fast. From the uncertain fate of the Stage 3 tax cuts to the silent creep of inflation-driven tax hikes, everyday Australians are facing a perfect storm of rising costs and shrinking relief. What makes this tax shock so alarming isn't just the size of the changes, it's how quietly and gradually they're unfolding. Whether it's the removal of offsets, the tightening of deductions, or the introduction of new property and wealth taxes, these shifts are poised to hit workers, families, retirees, and business owners across the country. And while some measures are being framed as targeting only the wealthy, the reality is that middle-income Australians are increasingly caught in the crossfire. Add to that the impact of global tax reforms, local government levies, and new compliance rules, and 2026 could be a year where many Australians find themselves paying more tax than ever, often without understanding why. It's not just about income anymore. It's about how you save, spend, invest, and even where you live. But here's the good news. Being informed is your first line of defense. Understanding what's changing and why gives you the power to plan smarter, ask better questions, and take steps to minimize the impact of your hard-earned money. The tax system may be complex, but that doesn't mean you have to be caught off guard. 2026 doesn't have to be a financial trap, but only if you're prepared for what's coming. Keep learning, stay alert, and don't assume the old rules still apply. Because in the new tax era, what you don't know can cost you.